Welcome, ladies and gentlemen. My name is Iosif. I'm the senior analyst of IronFX. Together we'll be going through a small presentation about the week ahead, mainly in the FX markets. Before we start though, a small reminder and the display of our risk warning and our disclaimer. Always remember that our products are traded on the margin and carry a high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and you should ensure that you understand the risks involved. Also, as a disclaimer, please note that the information in this webinar should not be considered as an investment advice or an investment recommendation, but instead as education material only. This material is just the personal opinion of the author, that's me in this case, and client's investment objective and risks tolerance have not been considered. Now, IronFX is not responsible for any loss arising from any information herein contained, and please note that redistribution of this material is strictly prohibited. Now, with no time to lose, maybe the most characteristic move of the market for the past few days was the drop of US stock markets, as the market increasingly seems to be pricing in a more aggressive, a more hawkish stance from the Fed. The market's questions are to be answered next week, as the Fed is to release its interest rate decision on Wednesday, the 26th of January. On the monetary front, we also note the same day the release of BOC's interest rate decision, which will be also of particular interest. As for financial releases, we note on Monday the release of the preliminary PMI readings for January, and that's from Australia, Japan, France, Germany, the Eurozone, UK, and the US. On Tuesday, the 25th, we note the release of the US Consumer Confidence Indicator for January, as well as New Zealand's trade data for December. On Wednesday, the 26th of January, we note the release of New Zealand's CPI rates, that's for quarter 4. On Thursday, the 27th, we get from the US the GDP advance rate for quarter 4, which is expected to be the main release of the day, as well as the durable goods orders growth rate for December. And finally, on Friday, the 28th, we get from Japan the Tokyo CPI rates for January, from the US December's consumption rate, as well as the final University of Michigan consumer sentiment reading for January. And moving to the US dollar, and this would be the USD index for our chart, and an upward trend line guiding the index for the time being. We would like to note that regarding the direction, the index has printed higher highs. However, we have to note that the differentials are low here, as you can see that the second peak is just above the first one. So the index may be finding increased resistance. Also, the fact that the RSI indicator is still above the reading of 50, which is a bullish sign, but it has a downward slope, and we may see practically some stabilization tendencies for the index coming. So for the time being, we maintain a bullish outlook, yet stabilization could come. And a possible break of the upward trend line would be exactly, initially at least, be signaling this stabilization. Levels to keep an eye out. To the upside, we note the 96.15, provided resistance here as well as support here. Also, we note the 96.65, which was the previous upward level of the prior sideways movement. Higher than that would be the 97.30. To the downside, we note the 95.60, which was considered to be the lower boundary of the index's past sideways movement. Lower than that would be the 94.95, and even lower the 94.40. Now, moving to USD's fundamentals, rising yields tended to provide support for the greenback. And it's characteristic that the 10-year yield on Tuesday, the 18th of January, had reached 1.8680%, That was a level not seen for 2 years, exactly reflecting the market's hawkish expectations. Overall, the market seems to have solidified its expectations for a tighter monetary policy and currently has fully priced in a rate hike of 25 basis points in Fed's March meeting, not this one, as well as 4 rate hikes in total for the current year, which are frequently mentioned by analysts. Hence, the Fed's interest rate decision is expected to be in the epicenter of the market's attention on Wednesday, the 26th of the month. Currently, Fed funds futures imply a probability for the bank to remain on hold at the January meeting of 96%, and that remains our base scenario. Should the bank in its accompanying statement actually pave the way for a rate hike to come and meet or even possibly overcome the market's expectations in sustaining a confident hawkish tone, we may see the greenback getting some considerable support. Also, do not underestimate Powell's press conference. That's half an hour later than the release, which had also moved the markets in past decisions. As for financial releases, we highlight the release of the US GDP rate advance, that's for quarter 4, on Thursday the 27th of January, and should the rate decelerate substantially, it may weaken the USD. As you can see also in the chart at your screen, we have noted a low point, which was in quarter 2 2020, as well as the high point the quarter afterwards. And as the GDP rate corrected, normalized, yet remained at rather high levels, accelerated levels, we have to note that there was a deceleration, a notable deceleration, for quarter 2 to quarter 3, that's of 2021. So, should the growth rate actually decelerate further into quarter 4, that would be definitely a bearish sign for the USD. On the other hand, should the GDP rate actually be able to escape this downward motion and show an acceleration, that could provide some considerable support for the USD. Also, we would like to note the release of the market preliminary PMI figures for January and Monday. On Tuesday, we get the US consumer confidence, and on Wednesday, we get the new home sales figure for December. On Wednesday, before the release of the Fed's interest rate decision, we also note the release of December's durable goods orders growth rate, and on Thursday, besides the GDP rate, we also get the weekly initial jobless claims figure. Finally, on Friday, the 28th, we note the release of December's consumption rate and the final reading of the University of Michigan consumer sentiment, that's for January. Moving now to the pound. This would be cables for our chart. Now, the pair has broken the upward trend line guiding it and seems to be having some bearish tendencies. Actually, the RSI indicator below the 4-hour chart tend to confirm these bearish tendencies, as a bearish sentiment seems to be evolving around the pair. And the fact that it has broken below the 1.36 is also adding for the bears. So we tend to see the case for the pair to start dropping. To the upside, we would still note the 1.36, which provided resistance twice. Also the 1.3720, which provided some commotion here. And finally the 1.3830. To the downside, we note the 1.3430. Practically, we're skipping the stepping levels, which are supported here, and move directly to the S1, which provided resistance and is now turned into support. Lower than that would be another prior resistance level, which has now been turned to support. That would be the 1.3270. And lower than that, we note the 1.3135. Now, the pound seems about to end the week low against the USD and JPY, but not against the euro. Yet overall, seems not to be so convincing about any bullish tendencies. Quite on the contrary, we would note. Moving now to the pound's fundamentals, the situation in the UK political scene seems to remain unstable, as the UK government is under pressure to resign over Partygate, while at the same time, the easing of measures to curb the spreading of the pandemic is well noted. Plan B restrictions in the UK are to be removed next week, in a move that could prove to be a gamble, as on the one side it could be one step closer to the normalization of the economy, yet on the other hand may allow the pandemic to spread faster, thus slowing the recovery of the UK economy. On the monetary front, we note BOE Governor Bailey's comments that he is worried that inflationary pressures are to linger on in the UK economy, something that tilts the scale in favor of further tightening of BOE's monetary policy to avoid a possible ingraining of inflation in the UK economic recovery. Overall, and given that the market seems to be pricing in a possible rate hike in BOE's next meeting, that's beginning of February, the monetary outlook of the BOE could be supporting the pound, at least for the time being. As for financial releases, we highlight on Monday, the 24th of January, the release of the preliminary PMI readings, that's for January, with special focus being on the UK services sector. Also, we would like to note the release of the CBI industrial trends for orders, as well as the CBI distributive trades indicator, both being for January, and you can see the relevant chart on your screens. Note how retailers have marked a distinguishable drop in sales, while on the other hand also industrial orders seem to be having a slowing inclination. Moving now to JPY, this would be USD JPY's 4-hour chart. Now JPY more or less ended the week where it has started. I would dare to say that the strengthening of the pair, the rise of the pair has been halted, that's clear, and bearish tendencies seem to be present. It's characteristic that the RSI indicator below the 4-hour chart is between the readings of 30 and 50, also implying a rather bearish sentiment, while a downward trend line has started to form. Should the bearish movement continue, we would expect the pair to break below the 113.70 support line, which actually reversed the downward motion during today's Asian session. And in such a case, we may see the pair paving the way for the 112.70 or even lower, the 111.75. To the upside, we note the 114.45, higher than that the 115.45, and in an extreme bullish scenario, the 116.30, which practically crowned the upward motion that was around the beginning 3rd to the 4th of January. Moving now to JPY's fundamentals. On a fundamental level, Japanese worries about coronavirus seem to intensify, as the country has recorded the highest number of new daily COVID infections on Wednesday, the 19th of January. It should be noted that the Japanese government has placed 13 prefectures, including Tokyo, under a quasi-state of emergency due to the spreading of the pandemic. Fundamentally though, given international tensions, we may also see JPY being sensitive to safe haven flows in the coming week. On the monetary front, we would like to make a comment on BOJ's interest rate decision that was on Tuesday, the 28th of January. Now, the bank, as was widely expected, remained on hold, and as we had mentioned in last week's report, raised its inflation forecasts reflecting the inflationary pressures in the Japanese economy. At the same time, though, BOJ Governor Kuroda recognized that inflationary pressures were rising, but also stated that BOJ had no intention of raising rates, given that inflation is expected to remain below the bank's target of 2%. Overall, the outlook for BOJ seems to remain firmly dovish, which could weigh on JPY. As for financial releases, we note that on Monday, the 24th of January, we get the preliminary Jibun Bank manufacturing PMI figure, while on Friday, the 28th, we note the release of Tokyo CPI rates for January, with a clear upward tendency both on a headline rate as well as on the core rate. Moving now to the common currency, and this would be Euro USDs. For our chart, a clear bearish movement with the relative downward trend line characterizing it. Nevertheless, we should note that there seem to be some signs of stabilization as the pair found considerable support at the 1.13 support line and seems now to be testing the downward trend line. Now, for our bearish outlook to change, we would require a clear breaking of the downward trend line pre-mentioned. Should, on the other hand, the bears continue to dominate the pair, we may see it breaking the 1.13 and start aiming for the 1.1235, which provided support once, twice, 3 times here, more or less, and was the pair's lower boundary of its past sideways movement. Lower than that, we also note the 1.1180. To the upside, we note the 1.1370, providing resistance here, aimed for here and here. And higher than that would be the 1.1435, while the highest level noted would be the 1.1510. Moving now to Euro's fundamentals. On a monetary level, we see that ECB's dovish approach may be one of the factors weakening the euro. It's characteristic that ECB President Christine Lagarde, in recent statements, reiterated the narrative of a temporary nature of inflationary pressures, as she stated that inflation in the Eurozone will decrease gradually over 2022, a statement which may imply that it may be less urgent for ECB to actually tighten its monetary policy. Now, should ECB officials continue to maintain a dovish stance in the coming week as well, we may see the euro retreating, as the interest rate differential outlook, which could be tilting in favor of the Fed as well as the BOE, which are tightening their monetary policies at a faster pace, instead of the ECB. In Euro's fundamentals, we also note the crisis in the Ukraine, as a possible escalation of the tensions in the area could increase the price of natural gas, which in turn could slow down the economic recovery of the area, thus could weigh on the common currency. Also, the pandemic has still a strong presence in the continent and should be taken into account. As for financial releases, we highlight on Monday the release of the preliminary PMI figures. That's for January and for Germany, France, and the Eurozone as a whole. Specifically, we intend to focus on Germany's manufacturing sector. That's the blue line on the chart on your screen. Also, France's services sector, which is the red line, and Eurozone's composite PMI figure, the green line on the screen of the chart. So we can see that especially Germany's manufacturing sector, which is also the spearhead of the largest economy in the area, had an acceleration of the expansion of economic activity in Germany that was practically from May 21 until around July 21, has decelerated up until September 21, and has stabilized at lower levels, but is still expanding. Should practically the readings show a further deceleration of the expansion of economic activity, actually breaking below 55 and start aiming for 50, that would be a worrying sign. On the other hand, that could also provide further support, not for the euro, but for ECB's dovish stance, as it worries more about economic growth rather than inflation. Now, other than that, we would also note the release of Germany's January IFO indicators, that's on Tuesday the 25th, as well as Germany's forward-looking GfK consumer sentiment for February, that's on Thursday the 27th of January. Moving now to the Aussie, and this would be AUD USDs for our chart. A sideways motion, a wide sideways motion between the 0.7295 and the 0.7170. Nevertheless, the Aus is about to end the second week in the greens against the USD despite the strengthening of the latter. We would like to note that practically, besides the R1, which is currently the 0.7230, and the R2, which is the 0.7995, we would also note the 0.7365 in an extreme bullish scenario. To the downside, we would note the 0.7170, lower than that the 0.71, note the support here, and even lower the 0.7050. On a monetary level, we may see the market also expecting a more confident stance on behalf of the RBA, which could provide some support for the Aussie should it intensify. It should be noted that the better than expected employment data for December, released on Thursday's Asian session, tended to exactly provide additional expectations for RBA stance, as the unemployment rate dropped more than expected and the employment change figure dropped, yet to a lesser degree than expected, both signaling that the tightening of the Australian employment market is still ongoing. On a more fundamental level, market sentiment could be the main factor behind the commodity currency's direction right now and in the coming days, as should there be a more risk-on approach, it could provide tailwinds for the Aussie and vice versa. As for financial releases, we highlight the release of Australia's CPI rates, that's for quarter 4, on Tuesday the 25th of January, which would complete the picture of Australian economy. It should be noted that, as you can see in the chart below, a deceleration was noted from quarter 2 to quarter 3, and a further deceleration could practically more or less moderate any confidence on behalf of RBA in its next meeting. As for other financial releases, we would also like to mention the release of Australia's preliminary market PMI figures, that's for January, on Monday the 24th of the month. Moving now to the CAD, and this would be USD CADs for our chart. Now, the technical analysis is a little bit ambiguous here, because on the one hand, we see that there are some bearish tendencies, given that the pair is printing lower highs, however so lower lows. I would remain rather hesitant though for a bearish outlook regarding USD CAD, given also that the RSI indicator is at the reading of 50, implying a rather indecisive market. Now, for our buyers, for a sideways movement to change in favor of a bearish outlook, we would require the pair's price action to actually dive below the 1.2495 and continue to print lower lows and lower highs. That would practically enable us to actually draw a downward trend line, which would be guiding the pair. Other than that, we stick to our sideways scenario. For the time being, we note, besides the 1.2495 to the downside, also the 1.2410 and even lower the 1.2330. To the upside, we note the 1.2585. Higher than that would be the 1.2695, which provided support once here and has now been turned into resistance line, and even higher the 1.2785, which practically capped the pair's upward motion that was around between the 5th and the 7th of January. Moving now to CAD's fundamentals, we have to note that the possibility of oil prices rising further could continue to provide support for the loonie, as Canada is considered a major oil producing country. Yet, we have to note and underscore that oil prices corrected lower for a second day yesterday and were still dropping during today's Asian session. So expectations for a tight supply of the commodity, the tensions in the Middle East, and the possibility of escalating tensions in the Ukraine tended to be factors that drove oil prices higher in the current week. However, those factors may be fading away. Should oil prices continue to rise, we may see CAD gaining further. On the flip side, should oil prices start dropping, then the CAD could start losing ground. Inflationary pressures in the Canadian economy seem to have to remain strong for December, both on a headline as well as at a core level, where the metrics reached an over 30-year high. Such inflationary pressures in combination with the positive employment data for December may imply greater expectations for a tightening of BOC's monetary policy, which is another plus factor for the loonie. Now, the market's questions are to be answered on Wednesday, the 26th of January, as BOC's interest rate decision is to be released. Currently, CAT over S imply a probability of 87.33% for a 25 basis points rate hike to be performed by BOC, thus practically bringing the interest rate from 0.25% to 0.50. Now, should the bank actually hike rates, which is also a base scenario, and should the bank statement also show a determination to keep inflation under control by further rate hikes if needed, we may see the CAD getting some support. Now, given the lack of financial releases, of high-impact financial releases from Canada, we would expect fundamentals such as oil news, market sentiment, and BOC's monetary policy to lead the loonie in the coming week. Now, before we leave you, and that's a general comment, overall in the coming week we may see the USD regaining its dominance in the Forex market over other currencies given the gravity and frequency of financial releases expected. Nevertheless, next week's calendar seems to continue to provide the chance for other currencies to shine as well, yet more scarce. Also, in the FX market, besides the pre-mentioned data and releases, we note the release of New Zealand's trade data for December on Tuesday, as well as New Zealand's Q4 CPI rates on Wednesday, which could provide volatility for Kiwi pairs. Besides the FX market, we note that for US stock markets, the earnings season is in full development, yet the course of the US yields as well as the market's hawkish expectations seem to create a distortion. It should be noted though that in the coming week we expect earnings releases such as Tesla, Apple, Johnson & Johnson and other to gather substantial attention. As for gold's price, we highlight that the negative correlation with the USD was on display once again in the past few days, as the precious metal more or less benefited from the weakening of the greenback, yet was kept at close bay given that practically US yields were on the rise at least until Wednesday. We would not be surprised to see the negative correlation between the US dollar and gold to be maintained in the coming week as well. That should be it from all of us here at IronFX. Best wishes for solid trading. Thank you.